Okay, do you want to save a ton of heartache with your trading? False breakouts can not only kill your trading account, but your confidence as well. In this video, Jeff Holden, SME's head of trader development, teaches you his technique for avoiding them and all that frustration that comes along with such losing trades. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our desk so you can grow your trading account.
This might be the best way to save you trading P&L. In this video, you're actually going to learn 3 steps to avoid false breakouts. This isn't a video that's going to make you a bunch more money, but it's going to save you from getting into those false breakouts. And at the end, we'll talk about an opportunity that comes specifically from these false breakouts. But the reality is, this video is all about getting into the right trades, letting them develop the right way, and sidestepping those really costly opportunities that don't quite evolve the right way. The reason why I'm so passionate about this is, actually, I really distinctly remember one of my worst rips initially after joining the firm. And I was in this trade, and it was a breakout trade, and I waited for the setup to occur, and I was really excited about it because all the variables seemed there, right? It was nice consolidation. The time of the consolidation was appropriate. The volume seemed okay, but not great. You know, like the width of the consolidation, or the height of the consolidation, the range was kind of what I was looking for. It started to do exactly what I thought was perfect. Couldn't have asked for a better setup. And I was really excited because, you know, I was here at the firm. I'm ready to put my risk on, ready to show everybody what I've got, imagining myself like thinking about how well this is going to trend into the close. And I'm going to be the trader that everybody's talking about after hours, like, man, that guy crushed it. As soon as I put the trade on, as soon as it broke out, it tricked me. It started to kind of work. And that led to this overconfidence in the trade. It started to go up, and it went up quickly. And I was like, oh, this is great. Maybe it's even going to work better than I think. Maybe I won't have to wait till the end of the day. Maybe it's just going to go, and I'll take my profits. And maybe by like 2 o'clock in the afternoon, I'll be getting those high fives from everybody on the desk. All of those things started happening in my mind very quickly. It seems like almost instantly the trade started going against me. It had gone up, it stalled, and then started to come back against me, and I froze. Legitimately, I think the combination of my expectations for what was possible, being up in the trade, the P&L, and then how quickly everything went against me, that led to that freeze. Just an absolute freeze. I mean, thankfully, I had a stop in place, and I was able to get myself out because of that. But I made a commitment to myself that I was not going to let myself experience that freeze again. I was just going to find a way to take that off the table. I had identified that trade working for me, having those high expectations for the opportunity, and then having something change and quickly have it come against me. Exactly what happens at a failed breakout. I identified that was a big trigger for me, for my trading. That was something that caused me to make a big mistake, one of the worst mistakes you can make in trading, and just freeze. So I became obsessed with identifying good breakouts, and then more importantly, how to sidestep the failed breakouts. Breakouts are just captivating. So we're going to define breakouts, and we're going to talk about like this common misconception that we'll clarify in a little bit. But defining the breakout, essentially, we're talking about a range that's built with multiple touches on each side. We define it typically as 2 touches on either side of a distinct range. That creates that range with a clear visual pattern. What's happening during the breakout is this energy is building up. The momentum for the stock is building, and we're expecting this powerful resolution. Most of the best breakouts evolve from trading in that range, that distinct price action, into a consolidation prior to that breakout. Consolidation and ranges are very similar definitions. The distinction exists in that a range can last infinitely. A consolidation almost always, and a part of the consolidation is it has a pending resolution to it. So when we're talking about ranges, we're expecting it to just continue because there's no expected resolution to that. A new catalyst has to come in, new change has to occur in the price action to lead to a break of that range. When a consolidation is occurring, we are planning for and expecting a pending resolution. So that distinct change can be really, really important. But not all breakouts are what they seem. I'm sure everyone here has been in a trade, seen a really good breakout, taken the really good breakout, have it look like it might work, and then it just go against you into a false breakout. A rough estimate is that 60% of all breakouts retest and that 30 to 40% of all breakouts fail. That's like a really broad stat, and it's not really that helpful of a stat to hang your hat on. It's kind of like saying that the average weather in New York in the winter is like 35 degrees, and it doesn't really help you when on a day like today it's like 15 outside. It's just nasty. So we're going to have to look deeper into the breakout to understand exactly how to avoid the ones that are prone to failing. If you can identify the ones that are prone to failing, you can sit back and you can change your risk allocation or your expectations for that breakout. And if it does work, you can let it surprise you. And if it doesn't work, you're more on guard. That's the first step to avoiding a false breakout. Understand the times that you need to be more on guard. And it's not every time. There's specific variables that we're getting into that we can talk about. What are the things that could occur that lead to you being more on guard? So let's look at those subtle clues that signal a false breakout. We cannot avoid false breakouts, but we can stack the odds in our favor, which is all we really need. So each breakout has a specific metric to look at. So we can talk about extended breaks, rangy breaks, or range into consolidation breaks. And then specifically, we can talk about the breaks that have too much pressure. So many wicks on one side. And the metric that we're going to use there is we're going to check the number of touches on either side of the range. Too many touches on either side of the range can lead to a break in that range failing. It's sort of like the idea of there's so much pressure and it really should have gone. And there are all these tests of that level and it just didn't do what it needed to do. If it does break out, it's very likely and prone to failing. So we have to be a little more careful about those. For rangy breaks can be prone to fail, specifically when they're not supported by increase in volume. Think about a rangy break, right? We're looking at an example of a rangy break. And when that range does break out, what should cause that range to break? It should be something new participation coming into the stock. It's very clear on a rangy break, we want to see that distinct and clear increase in volume. And then finally on extended breaks, right? So extended breaks are prices kind of up and then extends even further. You need to see that reset period. And the really simple concept that we're going to talk about is the length of the consolidation of that reset period. So that extended break is move up, little bit of a consolidation, and then continuation break. As long as that consolidation is long enough, or there's a little bit of a sidestep here, if the volume stays sustained enough, kind of going back to that rangy break, if we get that combination or a representative of that combination, those are the breakouts that we can really look for. Outside of that, everything else is prone to failure. On extended breaks, if they're not long enough, they're prone to failure. Not long enough with enough volume, prone to failure. Rangy breaks, they're especially prone to failure because it's so much price discovery that's occurring. That's why we need that volume differential. Too much pressure breaks. You really need something distinct. If it's pressing, that is the biggest catch because visually it looks so good. The way to sidestep this, we'll get to it in a second, is really to look for the buildup into the range. So that range that builds into the consolidation, kind of what we talked about earlier, that buildup is really an important factor. And more importantly is where that buildup starts prior to the range break. So we talked about the pressure breaks. What we really want to see and the best versions of breakouts are when the pressure was actually built on the other side of the breakout. It doesn't have to be a failed breakout on the downside and then a breakout to the upside. It can actually be just pressure built on the other end of that range prior to the breakout. that pressure building and then the build up into that is exactly what the best breakouts almost always look like. The other check that we want to have in our favor for these are having multiple time frames aligned. So we talked about how to avoid the kind of really bad situations. Now we're talking all about how to identify the really good situations. And then we're going to find a middle ground in that. But having multiple time frames aligned, if it's a consolidation above a key resistance level on a 1 minute chart, but it's also consolidating above a key resistance level on the 15-minute chart. And then you get a press down like that might break to the downside, but it never breaks. You just get pressure. And then you see the build starting with the volume increasing. That is exactly what we want to see when you have that multiple time frames aligned. A test up into a resistance level that looks like maybe it's going to break out, maybe it's going to break out, maybe it's going to break out, and then it does break out. Is that a trade you're going to take when you have multiple time frames aligned against you, or are you going to go with the move on the other side? And then most importantly, if you get that failure before the break, this is actually the failed breakdown into the breakout. That's going to be something that really sets you up for a lot of success. If you had a distinct failure on the other side, distinct failure meaning a quick attempt lower and it failed to get lower, and then a quick, very clear build and break on the other side. Those are exactly what we're looking for. Since we've talked about the setups and what specifically we're looking for into the breakouts, and we've covered about 6 different examples, but since we're talking about the setups, that's only the first part of the equation. That just gets us into the game. We can stack the odds in our favor by understanding the difference between those and reducing the likelihood that those will fail by the setup involved, but we're still prone to failure. And let's understand why it's so important to take a look at the price action as it's occurring after we've taken the breakout and update the narrative as it's going along. So first we're going to identify that good breakout, right? We're going to stack those variables in our favor. We're going to identify a really good press and then a really good build and then a really good increase in volume. We're going to take the breakout, but then we're going to have to identify what happens in the next 5 bars. So the next 5 bars are critical after the break. They're absolutely essential because they tell us the response to the break. Specifically, we're going to talk about what happens in the next 5 bars and how the next 5 bars will dictate, in a lot of cases, the likelihood that we're walking into a failed breakout or a breakout that's going to give us those legs that we're looking for, that multiple opportunity to the upside. Within those 5 bars, the first check that we're going to talk about is how are the bars looking? Really what we're doing is reading the tape, but even if you're not going to read the tape and understand if the tape is aggressive, passive, indecisive, or lethargic, even if you're not looking at the tape, you can look at the bars, even just the 1-minute bars, and you can start to think, is this aggressive participation? Is this passive participation? Those are the 2 that are acceptable. When a breakout occurs, you want either aggressive participation or you want passive participation. You do not want indecisive participation or lethargic participation. It seems pretty clear, but we'll look at some examples here. And as we're looking at the examples, you can see the difference between aggressive participation, where it just people are tripping over themselves to be involved in that breakout. Passive participation, where there's a big player that's underlying everything and they're likely to just be there for a period of time. Or that indecisive, almost that like quick, like, I don't know, like, is this going to work or is it not going to work? Even worse is that lethargic. It like goes up, but then it just has nothing there behind it. Those 4 characteristics are the first starting point that we look for in the next 5 bars. 5 bars after the break tells us everything we need to know about the probability of that break working or failing. If we don't get that acceptable category of bars, that aggressive or that passive buying on the upside breaks or selling on the downside breaks, and instead we get indecisive price action, even worse, we get lethargic response to that break, we have a really clear picture of what we're trying to do. and what likely is going to happen with this breakout, if it's going to work or it's going to fail. Now that we've identified a good break, what a good breakout looks like, how we've been able to sidestep the potentials of a failed breakout, and we've identified what should be happening in the next 5 bars, we have put ourselves in a position to make a trading decision. We can do one of 3 things. We can stand, we can add, or we can fold. We'll talk about 3 different trades here and 3 different actions that you should take. So we get that passive buying on the break, and that passive buying is there. That is the situation to stand. There's really nothing to do. We're expecting that big player to be there. We don't have to add risk because that big player is supporting it, and it's likely that this trade is going to continue for a nice sustained period of time. Our risk reward is going to take care of itself. The probability is showing us it's there. We just stand. If we take action, if we add or if we fold, we're probably taking away the EV of the trade. So that passive sustained buying to the upside or selling to the downside, that's just a reason to stand. We don't look for another trade quite yet. We don't do anything with it. We just hold our position. We don't exit it. We don't add to it. We just sit there. We can add when there is aggressive buying. So that build looks right. The break is appropriate. We get that quick move up and then that sustained buying pressure where we're holding the top part of the range for that 5-bar period. The reason we can add is because that's an entirely different trade on its own. Our add isn't adding to our core position. Our stop isn't below the low of the range or below the breakout price. Our stop's actually below that recent consolidation. We've seen the aggressive buying. So we're allowing that consolidation, that price action, to give us an opportunity to add to our trade. We can add and then look for that second leg, and we can exit our add into that second leg and still maintain our core. Finally, and this is the one that is most important to know, you need to be able to identify when to fold. And we talked about the unacceptable price action. That is immediately a fold. If you look at your trading P&L over the course of a year, over the course of your career even, the best opportunities will take care of themselves. And you want to make the most in the best opportunities. Even more importantly for preserving your upward sloping P&L curve is you want to fold when things are not at their best. Because those play more psychologically on you. Whether it works or it doesn't work, it wasn't working the right way. So it's really tough to sit there and say, if it works, wow, I made a good trading decision. If it didn't work, oh, I made a bad trading decision. The reality is it should do exactly what you want it to do, and we've identified what we want it to do. We want breakouts that are going to be met with aggressive buying or passive buying. Passive sustained buying. Finally, we talked about one of my favorite trading patterns, and really it's kind of a weird evolution that occurred, but wanted to bring it back to that. So let's say you take the trade and we get that breakout and the buying is just really lethargic, right? What do? Well, you fold, you cut your position. And then it fails and it comes back down. It turned into a failed breakout. So this is exactly why you fold your position, because now you can look at that failed breakout more objectively. Now, if that trade didn't work for me, does that mean it didn't work for everybody? Well, yes, exactly. All the participation to the upside there, everybody's wrong there. If you're disciplined enough to say, this is not trading the right way, and you fold, you exit your position, you're putting yourself in the position to take the other side of that trade, to take the failed breakout trade. So here's a very straightforward way to trade the failed breakout. You do not jump in as soon as it fails. That is like the biggest mistake, because what's happening, it failed on one side of the range, but it's really just in range. So it's into that cluster of activity. You want to watch the price action, and distinctly, if the sellers take control, Once it breaks the low end of the range on the other side, you can enter the position. And ideally, it's going to break the range and then give you even a retest. Those are the best ones. And then continuation. But the distinctness of the participation following the breakout can give you that failed breakout setup. You don't want to take everything as a failed breakout. Everything that breaks and then fails is not a failed breakout. It's not a trade. It's just an idea that what is coming later can turn into that failed breakout. So if you get that breakout that looks okay when you take it, and then you get that lethargic price action, and then you see it start to curl back down and you have to take it off because you don't have the criteria, you can exit your position, you can take a step back, get some objectivity, watch the price action and how the sellers are taking control. And if they do take control, they're likely to take it below the low of the range and then give you a failed breakout trade where you can enter against the high of the range, or if you have the right price action, especially if you get that break and retest scalp, that second chance scalp, you can stop right above that high. And you can walk into a trade that not only did you preserve your risk on the upside, but you could have made your trade on the day by being involved in the downside after the sellers really showed their hands. To sum it all up really quickly, we're going to avoid extended breaks unless enough time has gone by. And time usually means about 1/2 of the time that initial move occurred. So if the initial move was 15 bars higher, we want at least a 7-minute consolidation. That way we avoid that extended break of 15 bars, 2 bars, then we're looking for continuation. We're going to avoid ranging breaks without volume. We're going to avoid the pressure breaks where there's pressure to the upside, pressure to the upside, and then it breaks. Just too many touches is not appropriate. We're going to take the breaks with the appropriate buildups. That higher high, higher low, that distinct pressure on one side, and then it leading to the appropriate buildup on the other side. We're going to adjust our bet sizing, our position sizing, by thinking about what do we hold, where do we add, and when do we fold. What we didn't have time to cover here is our reasons to sell. And the reason why we didn't is we've already done a video on reasons to sell. So if you want to find a good reasons to sell video, which is actually a really nice complement to this, because when you're in a breakout, that can be one of the biggest traps is, well, where do I sell? Check out the reasons to sell video. We talk all about the differences in momentum style versus maybe a more trending style, and you can use that to put together an entire trade. It's a really nice guide into what we've talked about here on how to focus on and what to look for to exit this trade or any trade. And I really hope it helps.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.